to this video. In this video, we're going to cover the major differences between IPSAS standards as well as IFRS standards. Now, the way I look at IPSAS and IFRS, they are like siblings, as IPSAS are largely based on the same principles as the International Financial Reporting Standards. This is done mainly to ensure that there is comparability between entities in the public sector as well as entities in the private sector. As you know, International Financial Reporting Standards are largely for profit-oriented entities, whereas IPSAS are for public sector entities. However, the principles that underlie the financial reporting, the accounting of these entities should be the same. That's why I would look at them as siblings. So the differences between the IPSAS and the IFRS standards arise mainly from the changes that the IPSASB makes to reflect the difference between public and private sector entities. As you know, the different public sector entities have different objectives from the private sector entities. So there's going to be areas of divergence to really reflect the economic phenomenon of different transactions. Also, there are differences in the range of topics covered by the two sets of standards. There are principles, there are transactions that you will see in the public sector, which transactions are not in the public sector, particularly as it relates to transactions to do which are non-exchange transactions. Those concepts will only be covered in IPSAS, but not in IFRS. Then there's also a difference in timing. You'll see as the standards are being written, IFRS is always ahead, and sometimes there's a lag between when a standard has been dealt with by IFRS, it may not have been dealt with by IPSAS. For example, IFRS might have released a new leases standard, but at that particular time, IPSAS has not. So you see that there are going to be differences between the accounting for leases in the public sector as well as in the private sector. Now let's talk about some of the major differences that we see in the two standards. The first one is the issues around service potential as part of the definition and the recognition criteria. In the private sector, for us to have an asset, we should be able to demonstrate that that resource can generate economic benefits. But when you come to the public sector, it's not just ability to demonstrate economic benefits, but to demonstrate ability to provide a service. Because sometimes the objective has nothing to do with economic benefits, but rather to provide a service. I'll give you an example of a bridge. When a bridge is constructed, no one pays to use the bridge. So you cannot demonstrate economic benefit with regards to the bridge, but you can demonstrate service potential. So from an IFRS point of view, a bridge would not be an asset of the entity because there's no economic benefits to be generated, but it would be an asset in the public sector entity because we then have the service potential as part of the definition and the recognition criteria. Secondly, is the issues of exchange and non-exchange transactions. In the private sector, the bulk of the transactions, in fact not all transactions that are carried, are exchange transactions. You provide a service or good, and in return you get value that equal to the service or goods provided. So there is an exchange where value is transferred from one party to the next, and they pay for it or they deliver goods for it. But you see that in the public sector, there are certain transactions where there is no direct value that is given in exchange of the payment. For example, when you look at taxes, when you pay a tax, it's not like the government is going to give you a good or a service in return, but it's legislated and you just have to pay it. Public sector, these will have assets that cannot generate economic benefits. Then there's obviously need to look at how those assets are impaired. So we'll see the concept of impairment of non-cash generating asset also becoming another area of difference between your IFRS as well as your IPSAS. Then there's the issue of recognition from government grants. There is IAS 20, which deals with government grants from a private sector point of view. But you see, when we come to the public sector, these are very common, and there are areas of difference, particularly in the recognition of government grants, that represents areas of difference between IFRS and IPSAS. Then you'll see that in the public sector, there is an emphasis on budgets as part of the accountability for resources. So all public sector entities sometimes are required to publish their budgets. So one of the additions that you'll see in IPSAS is the need to compare between the budget as well as the actual results and provide a commentary. We don't see this happening in IFRS because there's no requirement for entities to publish their budgets. Then last but not least is the elimination of private sector specific concept. You see that concepts to do with IFRS 2, which is share-based payments, is not there in IPSAS. IAS 33 earnings per share, you will not find that in IPSAS, as well as IAS 12 income taxes, because the bulk of public sector entities are not required to pay tax. So to the extent to which an entity is required to pay tax, it will have to apply the specific IFRS. Thank you for watching this video.